Good afternoon. Today is January 28th, 2025. My name is Ward Keever, and I'm joined by Michelle Fisher. And we are delighted to have you with us today for our Covenant Wealth Strategies Stone Barn Speaker Series. Today is going to be virtual. We are joined by Mr. Jack Manley of JP Morgan, who I'll introduce further in just a moment, and Brittany Galato from JP Morgan also. So we're delighted to have them with us. This program is being recorded, and so we will have Jack share prepared remarks for about 30 minutes plus or minus, and then we'll have some Q&A. When Brittany puts the slides up, you will see that the questions can be emailed to Michelle, Michelle, that's 2 L's in Michelle, at covenantwealthstrategies.com. We'll have that up on the introductory slide as well as the closing slide for your convenience. Let me tell you a little bit about Jack. He is an executive director and global market strategist at JP Morgan Asset Management. Our Covenant Wealth Strategies team has had a long-standing and mutually beneficial and very successful relationship with JP Morgan. And so we're very thankful that Jack and Brittany are here with us today. In Jack's role, he is responsible for delivering timely market and economic commentary to both institutional and retail clients in the U.S. and Canada. In addition to that, he is a contributor to JP Morgan's long-term capital market assumptions, basically the framework that JP Morgan uses as a context for how they're going to handle investments. Jack is also a frequent guest on CNBC, Bloomberg, and Fox Business, and is often quoted in the financial press, and graduated from the University of Chicago with a bachelor's degree in history. And Jack, one of the questions I did not get to ask you in our green room before we started here is, how does a degree in history translate to investing? I guess you could say that if you don't learn from the past, you're doomed to repeat it. So maybe there's an aspect of that. Some fun facts about Jack, in addition to the fact that he's got a fabulous smile, is that he loves to cook Italian and watch British crime dramas, including Sherlock Holmes. That was the one British crime drama that I knew, but he also mentioned Midsummer Murders, which I did not know. I was not aware of, and I also did not know that there's a BritBox subscription option on I think you said it was Amazon.
That's right.
So basically, anything that the BBC puts out goes straight to Jack's bin, and he's up to date on all of the latest. He is also a viola player extraordinaire. He has played in chamber and symphony formats, and was, in fact, in his youth, I think it was in high school, was honored to be able to play for the United Nations as part of a orchestra. So without further ado, I'm going to turn it over to Jack Manley. And Brittany, I think you've got the slides for us. And then Michelle and I are going to go, per se, dark and with our video turned off, but we'll be right here in the background if you have questions or anything comes up. And then, Jack, when you're done with your presentation, we'll pop back up and we'll facilitate Q&A. Jack Manley.
Okay, well, that's wonderful. Thank you very much, Ward. That was a wonderful introduction. I think you did a good job, very judicious way of explaining how a history degree can translate into a career in finance. Because I was going to say not particularly well. It's a little bit of a challenge there, but I would say that the research process, the way that you learn to think about information, the way that you learn to synthesize information, communicate information, that can be quite quite valuable. So definitely something that I was able to pick up through my history degree. But I'm glad you noticed that. I'd also say, yes, I am a huge fan of BritBox. If you can take away anything from this call, it is a wonderful resource. If indeed you are a fan of those British mysteries, I don't think anybody does them quite as well as they do. Good Agatha Christie stuff. Sherlock, of course, is excellent. Vera is another one I will throw out there. But look, I know we're not here to hear about that stuff. There is plenty of other stuff to talk about right now for us as investors. There is, I would say, there's a lot of data out there that we're kind of reconciling. There are a lot of headlines, undoubtedly, a lot of volatility in markets. There is a lot of noise, I would say, for us as investors. And while, unfortunately, I cannot claim to have a crystal ball, Ward did not mention that right up front, right? I don't have one. It's not one of my skills. I cannot look into the future. I cannot tell you exactly what's coming down the pipeline. But what I can do, or at least what I want to try to do over the next half hour or so, is just try to see present conditions with a little bit more clarity, to sort of isolate the signal, so to speak, from all that noise that's out there, really hone in on those things that are going to matter most to us as investors, matter most to markets. And I think when I'm having conversations about markets, there is this framework that I've kind of developed that makes it a little bit easier for me to have more concrete views on investing, on portfolio positioning across asset classes, stocks and bonds in particular. And that framework is to say that, look, if you want to have that view on investing, on risks and opportunities, you have to understand what's going on with interest rates. And when I say interest rates, I mean in particular the Federal Reserve and monetary policy. The cost of money is so important. It dictates the coupon that you clip in fixed income, the role of duration within stocks, its valuations, its future earnings growth. I would actually argue that the cost of money is the single most important thing that you can have a view on if you want to have that view on investing. But if you want to have that view on the cost of money, on interest rates, you really got to understand what's going on with the underlying economy. Because when the Federal Reserve gets together, like it's doing actually right now as we speak through tomorrow, and there's a press conference, there's a statement, maybe they do something with interest rates, right? All of these things are happening in response to underlying macroeconomic variables. The Fed, thanks to its dual mandate with Congress, explicitly pays attention to employment and inflation. So we need to pay attention to those things as well if we want to have that view on rates, which again is foundational for having that view on investing. That's the framework. It's also the agenda. That's how I'm going to be structuring today's call. So with that in mind, if we could turn to the first page of the presentation, which would be page 17 from this guide to the markets, please, Brittany. And this is the full guide that we have in front of us. It is, I believe, 68 pages worth of content. I'm going to spare you all of that and focus just in on the handful of slides that I like the most. Page 17 is a good place to start. We don't have full year GDP growth out just yet. We don't know exactly what happened in 2024, but if I had to guess, it seems pretty clear that 2024 was another good year for the U.S. economy, another year, I would say, of unexpected resilience in U.S. economic growth. A lot of people called for a recession in 2023. That never materialized. A lot of people called for at least a serious slowdown in 2024. That never materialized. This has been an economy that, despite all the naysayers, has really been firing on all cylinders. And if you're trying to figure out where this economy is going from here, where it will go through 2025, it is worth understanding where this unexpected resilience actually came from. And if you look at the right-hand side of this slide from our guide to the markets, you will see that almost 70% of U.S. GDP comes from consumption. This is a consumer-driven economy. But even more interestingly, we've actually done a little bit of research here looking at quarterly GDP growth. And if you look at quarterly GDP growth going back to the start of 2021, the only one of these components on the right-hand side of the page that has been consistently additive, consistently positive for GDP growth has been consumption. Everything else has kind of ebbed and flowed, grown and shrank, but consumption has been the one stable, dependable, steady source of economic activity these past few years. Therefore, I would argue that unexpected resilience in the economy must be linked to unexpected resilience in the consumer. Well, now you got to pull this thread a little bit more, right? Well, why has the consumer done so well? And there are a number of different factors that I can point to here. But for the sake of time and making sure that these messages are tight and concise, there's one that I'd really like to hone in on, and that's the labor market. This has been a strong labor market. And when I say a strong labor market, I mean a low unemployment rate, strong payroll gains, very robust wage growth, low layoffs, low jobless claims. All of these things so important for empowering consumption because either directly they've helped out, right? Wage growth beating inflation means the purchasing power increases, or indirectly they've helped out. There's been a psychological component to all this, helping the consumer, right, on the right-hand side of this page. We know that we're all dealing as consumers with the same kind of laundry list of issues: high prices, high rates, geopolitical, domestic policy uncertainty. But hey, at least most consumers that want jobs have. And not only do they have those jobs, but they're pretty happy with what they're getting paid, and they're pretty confident that they're going to have those jobs tomorrow and next week and next month. And so they feel empowered to swipe that credit card today because they know in the not so distant future, new paychecks hitting the bank account. That's why this engine of growth continued to turn, the strength of the labor market. And so if we're trying to have that view on where the economy is going in 2025, it is helpful to have a view on where the labor market is going in 2025. And so if we look several pages down, page 27 from this guide to the markets, we can have that conversation. Thank you. Now, recently, as we can see on the left-hand side of this slide, which looks at non-farm payroll gains, the pace of job creation in this country has decelerated precipitously, right? Several years ago, we were adding 6, 7, 800,000 jobs to the economy. Now we're adding more like 1, 2, or 300,000 jobs. There is a lot of concern that this gray line, which represents the 3-month moving average of payroll gains, is going to continue to move lower until it crosses over that x-axis and eventually turns negative. But I'm not concerned about that because the pace of job creation today is a lot more normal than the pace of job creation a few years ago. Because the pace of job creation a few years ago was the pendulum swinging in the other direction post-COVID. We're adding 7, 8, 900,000 jobs per month because a year before we were losing 7, 8, 900,000 jobs per month. The pace of job creation today, again, is a lot more normal. This is what it should look like in a normal economy. But even more interestingly is what we show on the top right side of this page, which looks at the sources of labor supply, labor force growth in the United States. And if you look at 2021 and 2022 and 2023, and I would bet the same is true in 2024, the largest driver of labor force growth in the United States has been immigration. People moving here with visas and paperwork to work in our businesses and industries. And this has been extremely important for U.S. growth because our own domestic demographics are working against us. Our population is aging. With the baby boom rolling out of the workforce, the birth rate is declining. Americans are having fewer and fewer kids. Immigration has been the major driver of labor supply growth over the past half a century or so. And there's a new president in the Oval Office as of last Monday. And while policy is still crystallizing and we're still trying to get a view on exactly how all this stuff is going to shake out, we know that immigration will be front and center. And we can guess somewhat confidently that there will likely be less immigration this year, not more of it. Perhaps something similar can be said for the year after this one, which means that this single largest driver of labor supply, immigration, might start to get handicapped, which could actually translate into an even tighter labor market, a lower unemployment rate, stronger job gains. All of that translates into a more empowered consumer, which in turn translates, I think, into another year where the US not only avoids a recession, but actually is able to grow modestly above trend. Now, if we flip forward 2 pages, please, to slide 29, we can have a conversation about inflation. And very clearly, the inflation narrative has shifted a lot over time because starting in June of 2022, that's going to be the high water mark in the middle left side of this page. We made a lot of progress on crushing inflation in a pretty short period of time. But starting about a year and a half ago in June of 2023, it feels like that progress has sort of stalled out. We went from 9.1% on inflation, the hottest inflation has been since 1981, to 3.0% inflation, a fairly normal read, all things considered, in 12 short months. But since then, we've gone from 3.0 to just 2.9. That's the most recent read as of December, which we got just a few weeks ago. And if you're trying to figure out, well, where is inflation going from here, it is helpful to understand how inflationary forces have shifted over this time period. In June of 2022, we'll take on that one number because it's the worst one on the page. What was going on around the world? We had Russia having just invaded Ukraine, two very large producers and exporters of commodity products, food and fuel. And we don't know how the war is going to disrupt our ability to access those products. And so prices rise in response to that concern. At the same time, China is doubling down on a zero COVID containment policy. While the rest of the world has learned to live with this thing and moved on, we've reopened, we're back in school, we're back at work. China is still trying to stamp out the virus. And as part of that zero COVID initiative, their manufacturing output is hamstrung. And we don't know how policy is going to interfere with our ability to get a hold of finished goods that make their way through Chinese plants. And so prices spike in return. That inflation that we saw in 2022 when things felt like they were out of control was largely supply chain driven. But the interesting thing about supply chain problems is that they always get fixed. Might take time, might take money, but they always get resolved. And that is actually what's happened over these last couple of years. We resolved these supply chain problems. You'll see that energy, the green bar, it's not inflationary anymore. It's actually deflation. Orange, the core goods, core goods bar on this page, it's not inflationary anymore. It's deflationary. The stuff that's driving inflation today is not supply chain related, and that's why it's been so hard to shake. You look on the right-hand side of this page, and you can see that shelter costs in dark blue are the largest source of inflation. Auto insurance costs in dark red are the weirdest source of inflation. They basically did not exist on this page until a couple of years ago, and now it's 10% of all the CPI. And spending on things like dining, travel, leisure, hospitality, the light blue bar, slowly but steadily getting bigger as the consumer remains empowered. So as I look out over 2025, I think we might make some modest improvements on some of these numbers. The dark blue bars are slowly getting smaller. The dark red bars are slowly getting smaller. But I also don't think we're at any risk of inflation moving meaningfully lower anytime soon. In other words, it kind of feels like we've settled into something along the lines of a new normal, a term that I really don't like to use, but I think it is applicable here. And another sign, I should say, as we move through 2025, that this year is probably going to be a hotter year than what we would have otherwise expected from a macro perspective. Warmer growth, tighter labor market, and hotter inflation. So you have this view on the macro. Now you can have this view on interest rates, which again, I think is foundational for having that view on markets. So let's flip forward a few pages, please, to slide 32 and move on to kind of the second portion of this talk, so to speak, which is to say, well, what's going to happen with rates? And unfortunately, there is no obvious answer to that question. And we show on the right-hand side of this chart two things. In dark blue, we show you what the Federal Reserve itself has told us it's going to do. That's what's referred to as the dot plot. And the Fed puts this out on a quarterly basis. And in fact, there's an even more recent forecast than the one that we have on this slide as of just about a month ago. And in that dot plot, the Federal Reserve told us that after 100 basis points of cuts last year, we should expect another 50 this year, followed by 50 the year after, and 25 in 2027. That is 25 basis points of cumulative easing out of the Federal Reserve over the next 2 years. But the other thing we show on the right-hand side of this page is the green line, which represents what the market thinks is actually going to happen. And whereas that blue line is only going to change once a quarter, the green line is going to change every second of every day. And I will tell you that as of this morning, the market thinks that we're only getting between 25 and 50 basis points of cuts this year, with nothing in 2026 or 2027. In other words, these two lines, the gap between them has actually widened in the last couple of months. What this means is that there is room for interest rate volatility because there's only one right answer. The market doesn't know what's happening with rates. The market doesn't know what the Fed is going to do with interest rates. The Fed itself doesn't really know what the Fed is going to do with interest rates, at least not anything beyond this year. And that volatility in rate markets is something we've already been experiencing over the past few years, and is something that will likely persist over the course of 2025 as we work to figure out what the right answer is to this question about where rates are going and grapple with all this uncertainty that we have from a data perspective, a policy perspective, a macro perspective writ large. So we have this view now, right, on the macro, pretty good, warm economy. We have this view on interest rates, which is that maybe they're going lower over the short term, but there's a lot of uncertainty beyond that. I think we can now move on to that third portion of the talk, which is to say, well, what does all of this mean from a portfolio positioning perspective? Let's turn to page 35, please, to start by talking about fixed income. And I always like to start by talking about fixed income, not just because I think it's a natural transition away from a conversation about interest rates, but also because fixed income, I think, has a bad reputation with a lot of investors. And for what it's worth, that bad reputation is sort of well-deserved. In the aftermath of the financial crisis, the Federal Reserve cut interest rates down to zero. And for about a decade, there was no income to be found in fixed income. And then all of a sudden, the Fed starts raising interest rates to fight all that inflation that we were talking about earlier. Income does reemerge in the bond universe. And in fact, the coupon's as good as it's been in decades. But any bond that you bought before the Fed started raising rates plummets in value. And for a lot of fixed income investors, bonds went from doing nothing in their portfolio to actively hurting. And now a lot of them feel burned. They feel like bonds betrayed them. They feel like bonds are broken. But I don't think that's the case. Bonds aren't broken. I think they're just misunderstood. Now, I like these frameworks for having conversations about markets. Another framework that I use is one for fixed income in particular. And it's to say that interest rates, which of course are going to matter a whole lot for fixed income, can only do three things. They can move up, they can move sideways, or they can move down. There is no fourth option. And if interest rates are moving sideways, that to me means there have been no big surprises. And the economy keeps on doing what it's been doing. No big beats or misses in the data, no big shocking geopolitical headlines. And in this environment where interest rates move sideways, your fixed income return experience is the coupon that clipping. And that's pretty good news. Because if you look at the left-hand side of this page at the yield column for all these different parts of the bond market, you'll see that the coupon here is about as good as it's been in 20 years. And in fact, over the past couple of months, has only gotten stronger. But if interest rates move in either direction, up or down, that to me means that there has been a big change in the macro landscape, right? A big beat or a big miss in the data, a big headline that we weren't expecting. And as the view on the economy changes, the view on interest rates must change as well. And in these scenarios where rates are moving higher or lower, your fixed income return experience is going to be the coupon that you clip, plus or minus the impact of that change in rates, the impact of duration. And I don't think there's a better chart out there to explain that point than the right-hand side of this slide from our guide. We have those three scenarios on here. The dark blue is what happens if rates are falling. The light blue if there's no change. The dark gray if rates are rising. And almost uniformly across the board, top to bottom, you can see that in two of these three scenarios, you're making money. And in the third, where you're not, when interest rates are rising, which frankly is where we've been over the past few months, your downside is capped because of that coupon cushion that we've worked so hard to build up over these past few years. Rates move higher, rates move lower. You clip that coupon no matter what. And so what this means to me is that there is still to this day more upside potential than downside risk in fixed income markets, and that there is a role for bonds in portfolio construction, despite some of the disappointment over the past few years. Now, if we flip back a lot in this deck to slide 12, we can have a conversation about the equity market. And clearly some volatility in markets as of yesterday, some crazy news out of China about their new large language model and their ability to beat ChatGPT, right? A lot of noise in markets, a lot of volatility in markets. But if we ignore that noise for a second and take just a step back, we have to reflect on the magnificence of this market performance. You look at the table on the left-hand side of this page. In 2023, the S&P 500 returned 24%. And we have full year 2024 numbers, of course. And in 2024, the S&P 500 returned 23%. You add those two things together, and through the power of compound interest, you are looking at about a 50% return out of large cap US stocks over the last 2 years. Now, despite the fact that this market has made anybody that invested in it a whole lot richer, I still find that a lot of investors don't really like investing in US stocks. They're nervous about it. They don't like how strong this rally's been. They don't like how quick this rally's been. They don't like how so much of the success of this market has been predicated on the success of a very small handful of names, the Magnificent Seven. They don't like that the Magnificent Seven is turbocharged on excitement around long-term speculative technology like artificial intelligence, which translates into elevated valuations and increased vulnerability to shocks like we saw yesterday. And they don't like that any given day, day in, day out, we're trading either at or near all-time highs. It is admittedly a lot more difficult than it was a couple of years back to stay constructive on US stocks. But I do this by remembering one very simple thing, which is that over the long run, prices in the equity market are going to follow earnings. You're not buying a stock unless eventually it's going to make you money. And if you look at the top right side of this slide, which breaks out earnings growth in the S&P 500 between the Magnificent Seven, which is in green, and what I like to refer to as the S&P 493, or the S&P 500 minus the Magnificent Seven in blue, you will see that in 2025, analysts are projecting for the S&P 493 to have their best year of earnings growth in almost half a decade, with these two bars getting closer and closer to one another as we get towards the end of this year. For the first time in a long time, we are fishing in a much bigger pond. You don't have to look at just 7 names anymore. You can look at all 500 companies in the index. Now, I am a long-term growth bull. I am a long-term tech bull, and I believe in the success of a lot of these Magnificent Seven names. But I also acknowledge that with where valuations are right now, with all the uncertainty that we have from a data perspective and a policy perspective and a rates perspective, we might want to be a little bit more cautious with our allocation this year. And the best way to do that is not by pitting necessarily style boxes against each other or sectors against each other, but by thinking about this market bottoms up, security selection, and active management. That's the way to appropriately embrace the U.S. equity market opportunity. Now, if we turn to the next page here of the deck, of my presentation rather, which will be page 51 from the Guide to the Markets. Thanks, Brittany. Sorry to keep you guessing on that. Page 51 from the guide. We can spend just a little bit of time talking about international markets, which, to be clear, is one of my least favorite things to talk about. Nobody ever wants to hear about international markets. I don't like to talk about international markets because international markets for a very long time have been the promised land. And yet every year, without fail, they fail to deliver on those lofty expectations. I still believe an overweight to US equities makes sense in today's environment. But I also acknowledge that there is a way to stay constructive about foreign markets, to broaden your horizon a little bit. The key is to not think about things like valuations or interest rates or earnings growth or whatever, and instead focus in on longer term secular themes and trends. When I think about Europe, for example, I think about delicious chocolates and great bottles of wine, fast cars and nice watches and beautiful handbags, right? And nobody does luxury better than the Europeans. And it's a hyper cyclical play because as the world gets wealthier, both developed and emerging, a little bit of that new wealth gets clipped off and spent on these status symbol items. When I think about the emerging world, I think about how the US and the West collectively, we are moving away from China as a sole source of cheap goods and cheap labor, and that is only going to accelerate under this new administration. But I also realize, right, that while a lot of people think that may mean we are deglobalizing, we aren't. In fact, last year, the United States imported more goods at least, from Mexico than it did from China, from Europe than it did from China, about as much from Canada as it did from China. And countries like Indonesia, the Philippines, Taiwan, India, Korea, Vietnam, our imports from these regions are steadily increasing as well. We're not deglobalizing, we are re-globalizing. And all these countries around the world are lining up to pick up that mantle of responsibility and grow as we move through 2025. So again, I like U.S. stocks. I like them more than international stocks. And oftentimes I don't even talk about foreign investing, but I figured I might as well share again a framework that might be helpful when you're assessing those opportunities overseas. Which brings me now to page 60 from the guide, which will be the last slide in my prepared comments. This is our asset class returns page, which will show 15 years of returns across stocks and bonds and a lot of other stuff. Now, I just spent the last half hour or so going over some high-level thoughts on what may happen with growth and employment and inflation, how those things may translate into interest rate policy, and how all that ends up from a portfolio positioning perspective. But one of the things that you got to remember, and I said it right up front, I don't have a crystal ball. I cannot gaze into the future, which means that everything I just told you is kind of a guess. They're good guesses, I would argue. They're guesses that are backed up by a lot of research and some good looking charts, but they're guesses nonetheless. One of the things that should jump off this page to you is that in any given year, it is impossible to predict the winners and the losers, because in any given year, it is impossible to predict that next big source of volatility. It wasn't too long ago that no one had ever heard of COVID. It wasn't too long ago that we weren't talking about a war in Europe, or large language models, or chat GPT, or a regional banking crisis. Wasn't that long ago we weren't talking about a full-blown war in the Middle East. It was like a week ago no one had ever heard of DeepSeek. I mean, stuff happens really quickly, and it turns these outlooks on their heads. So instead of trying to predict that next big source of volatility, you have to do the next best thing, and that's prepare for it. And you do that by working with financial professionals like folks at Covenant Wealth, and by diversifying, which unfortunately is oftentimes a little bit easier said than done. And we live in this world of instant gratification at our fingertips. I hear so often questions like, why would I own bonds when I can just own stocks? Why own value when I can just own growth? Why own Europe when I can just own the US? Some people even want to know why they own any of this stuff when they can just buy Bitcoin. But we're not day traders. We are not chasing performance. We are long-term investors looking for long-term investing success. And if that is the mindset, then I think we have to remember that the journey is oftentimes just as important as the destination. And diversification is that thing that's going to get you there safe. I'd like to thank you all very much for the time. It's a pleasure to be here and deliver these prepared remarks. Ward, Michelle, I will pass things back over to you to open things up for questions.
Super. Jack, thank you so much. That was fantastic. I've got 3 pages of notes. We had a couple of questions come in. We actually had a couple of questions that came in ahead of your presentation today.
Oh, good.
So again, just thank you so much for sharing with us from your wealth of knowledge and experience. And I wanted to let you know on that crystal ball situation. So we recently learned that our crystal ball, I always wondered what those three holes were in the crystal ball. Turns out it was somebody's bowling ball that they had left around for us. And we have been looking to that all this time for our understanding. I'm being facetious, of course. Um, I love what you said about the U.S. economy is in good shape. For years, literally, we have been hearing prognosticators and fear mongers talking about recession, recession, recession. Our perspective here at Covenant, similar to your own, is that recession, generally defined as 2 consecutive quarters of negative GDP, 2/3 of GDP is consumer spending. Consumers are also known as employees. And so as employees, if they have jobs, they will spend. If there's job security, they will charge or, mortgage the future because they expect those paychecks to continue coming in. And I think it's true, you can confirm or correct my understanding, Jack, that we have actually never in recorded history had a recession with unemployment below 5%. So we've been pretty, solidly under 5. And even as quote unquote employment has gone up, it is nowhere close to 5%. And so the chance of a recession, quite frankly, we don't think is anywhere on the radar screen, not in the foreseeable future, so long as unemployment stays subdued and as long as we keep seeing wage gains and some other things going on. I think that the economy should continue to be in pretty good shape. One question that came in, which also I thought this was a great question. So when you talk about inflation, I think you were either on slide 17 or maybe it was slide 27, and you're talking about inflation. And a large part of inflation, specifically the CPI, I think it's over a third of CPI weighting is quote unquote shelter, aka housing. And when they talk about core CPI, that's when they strip out food and energy because of course nobody eats or puts gas in their car. But core CPI, I think over 60% of core CPI weighting is quote shelter. And so when we were looking at that chart, there was a lot of dark blue on that inflation number. What are your thoughts about shelter? How do we fix this? It seems that it's a supply and demand situation. It seems as though there is a structural imbalance. I've read and heard numbers anywhere from 1.5 to 3 million housing units short. I don't know how you deplete demand. So does that mean our only option is to increase supply? What are your thoughts on that?
Yeah, so two excellent questions on this one, and I appreciate you bringing that up. I love talking about shelter. And one of the things that I think is important to acknowledge is that when the Bureau of Labor Statistics, which is the governmental body that puts together those CPI numbers, looks at shelter costs, it is not actually looking at home prices, which I think a lot of folks would expect it would do. It is instead much more closely looking at rent, either directly through something called rent of primary residence or indirectly through something called the owner's equivalent rent. And what that means is that the Bureau of Labor Statistics will call up a homeowner and ask them, how much would you rent your place for if you had to rent it tomorrow? And, some of that is finger to the wind, like, I don't know, I'll throw out a number. Some of it is going on to Zillow and figuring out what the local rental market looks like. So rent is actually a key driver of shelter inflation, not home prices. And that's important to point out because while the Federal Reserve was putting all this upward pressure on interest rates, right, through 2022 into 2023, they were also putting a lot of upward pressure on mortgage rates. And as you mentioned, there is a chronic housing shortage out there, which meant that home ownership became very difficult for people that did not already own their homes. Really, really challenging to buy into a market where prices don't fall meaningfully because there aren't enough homes, but mortgage rates or mortgage payments triple or quadruple depending on where you're looking. So what do you do if you can't buy? You rent. And it is no coincidence that while the Fed was busy raising interest rates, median rents in this country increased by over 10%. Now, as we were looking out into 2025, when it felt like rates were going to be moving down a lot more quickly, and in turn, mortgage rates were going to be moving down a lot more quickly, it felt like we'd start to see a lot more pressure, downward pressure on those shelter costs because mortgage rates move lower. People feel more comfortable entering the market. Buying activity picks up, demand for rental units decreases, and inflation cools off a lot more quickly. Now, with long rates having backed up, with mortgage rates sort of back to where they were 6 or 7 months ago, that story has deteriorated a little bit. I don't think the blue bars are necessarily going to get much bigger, right, when we think about shelter costs, but I also don't think they're going to be zeroed out anytime soon. And as long as mortgage rates stay high and supply stays constrained, that contribution to inflation is likely going to stay robust. Another reason why I don't think we're going to see 1.5% inflation anytime soon. Now, to address your second point on this chronic housing shortage that we have, it is a big, big problem. And part of it is that there's not enough supply because we're still not building really to the extent that we were before the financial crisis. Subprime spooked a lot of builders. And when they are building, they're only building the really nice stuff. I live in New York City. I live on the Upper East Side in Manhattan. And I live in a charming pre-war building. It's got 6 floors, and it feels like every week a building next door around the corner gets demolished and rezoned to put up some 60-story glass and steel monstrosity, where the starting price for a studio apartment is going to be $6,000. Like, the stuff that's getting built is not for the everyman, which complicates stuff. So there's already a lack of demand. Excuse me, a lack of supply. There is also a lot of demand. And a lot of that demand comes from strong wage growth and strong population growth. And a lot of that strong population growth, as I mentioned earlier, comes from immigration. So we may see a little bit of that demand ease up if immigration policy changes meaningfully. But I think much more likely, now that some of these supply chain bottlenecks have been resolved, and that there are more construction workers out there than there were a few years ago, we're going to see a boom in building activity. You got to build. There's so much demand. And so when, I didn't mention any sectors earlier when we're thinking about the equity market, I like financials, I like healthcare, I like materials for this story that we're talking about right now. This demand for housing stock in this country is voracious. There's so much work to be done.
When you say materials, would you include in there like home builders?
I would indeed. And builders and the stuff that they use to build.
Yep. Yeah, it's just fascinating. We have a number of clients, a number of relationships. Basically, anybody who's graduated from college in the last 5 years, they haven't been able to buy a house. And it's interesting, Jack, because it's not like it resets every month or it resets every year. Like, the line of people who want to buy a house is getting longer and longer and longer every month and every year. It's not demand destruction, it's demand delayed. And all these people still want to buy a house. If they're getting married, they don't want to live with mom and dad. If they're having babies, they don't want to live with mom and dad. They don't want to live with their roommates if they're having, getting married and all that kind of good stuff. So that's what we're seeing in terms of housing. I just think it's a fascinating theme. I don't think that you are, per se, the supply and demand. The issue is not reducing demand. The issue is bringing up supply, for sure. Yep. I want to go back and talk about something you mentioned as part of that, and this was consistent with the question that had come in earlier. So talking about interest rates, I think you and I maybe have an understanding, but if you could speak to, the Fed has dropped interest rates. In fact, since September, the Fed has cut interest rates 100 basis points, which equals 1%. And so people were waiting. They were saying, hey, the Fed's cutting interest rates. Mortgage rates should come down. But in fact, the Fed has cut 100 basis points or 1%. And meanwhile, mortgage interest rates have gone up by more than 1%. So why is it that when the Fed cuts interest rates, that mortgage rates don't come down? And I'll give you a little lead in. I think the yield curve is what people are missing, understanding the difference between what it means when the Fed cuts on the yield curve and how that impacts things.
Yes, I mean, I would say that I guess it is sort of unusual that the Fed has been cutting interest rates and yet longer rates are moving higher. So don't think that that's like the new relationship, right, between short rates and long rates. But it is also, to your point, worth pointing out that the Federal Reserve only controls that overnight rate. They determine how much banks can make by borrowing or lending to the Federal Reserve. Everything else beyond that overnight rate is dictated by market forces, one way or the other. And interest rates have risen along further down the curve. In other words, risen in parts of the curve where the Fed does not have direct control, because the economic outlook, as we talked about earlier, has, I think, improved over the past 6 months, right? People thought that rates were going to be much lower because people thought the economy was going to be slowing down a lot, that inflation would be at 1.5%, 2%, that the unemployment rate would be at 5%, whatever. You can kind of throw out some random numbers around there, but just what we're seeing now is a warmer economy, right? Growth that's above trend, an unemployment rate that's closer to 4, inflation that's closer to 3. We don't need rates to be as low as we thought we would need them 6 months ago or a year ago or 2 years ago when the Fed was talking about just the beginning of the cutting cycle. And so rates along the curve have backed up to reflect that. So the Fed's doing one thing on the shortest end. The market is doing basically everything else out there, and the market is seeing a stronger economy.
Yeah, and I think what people are missing is the idea of the yield curve. So when people are asking me about that, I try to explain to them, or I suggest that they research the yield curve, because as you said, the Fed's only controlling the overnight rate in the same way that there are then 3-month CDs, 6-month CDs, 12-month CDs, 24-month CDs. Typically, the longer the CD term, the higher the interest rate. The same thing holds true with the Fed at the short term overnight versus, for example, a 10-year Treasury is typically going to have a higher interest rate. So just because the Fed's manipulating the short end of the curve doesn't necessarily apply to the whole curve. And in fact, as you said, as the Fed manipulates the short end of the curve and brings it down, that's considered stimulative from an economic standpoint, which would then, typically drive up those intermediate to longer term interest rates.
Mm-hmm.
If I could ask you to speak a little bit, per se, housing, but just infrastructure, power grid, resiliency of the power grid. There was a bit of a freak out yesterday because of DeepSeek. But prior to that, there was a whole lot of conversation on we're going to need more energy. We're going to need more energy. We need maybe gas power plants, maybe nuclear power plants. Oh, by the way, you've got to have an infrastructure build out because our grid hasn't had money invested for 50 years. Can you speak a little bit to that, Jack?
Yeah, this is a multifaceted question that is very much in flux right now because of the news out yesterday. But if I can kind of wrap my head around this, the idea in general was that, to your point, artificial intelligence is slowly but surely set to take over the world. But artificial intelligence, at least as we knew it up until yesterday morning, was an extremely energy intensive process. Like, the amount of energy that you have to throw at a query into ChatGPT is an order of magnitude higher than the amount of energy that you have to throw at a query into Google, right? So in order to support this transition over into artificial intelligence, there was all of a sudden this clamoring for an increased spending on infrastructure, and that's building out the grid, as you said. It's developing and enriching our own domestic energy production. The result of that, though, is kind of up in the air because, first of all, we know that the administration right now, the new administration, is very keen on increasing fossil fuel production, which in theory could help alleviate this energy issue. However, it is important to point out that 2024 under the Biden administration was a record year for U.S. energy production, and 2023, the year before that, was a record year for U.S. energy production. It's not like we're not pumping a lot. We are pumping a lot, and you can always pump more, I guess, but it's not like there's a 50% capacity increase just hiding behind regulations. That's not really the way it works. I think the tariff conversation also complicates this story. You were talking about the potential for levying 25% tariffs on trading partners like Canada. Canada's largest export to the United States is energy products. About a quarter of all the gasoline that we consume in this country comes from Canada. And if you're going to levy 25% tariffs on Canadian energy exports, Canada can say, okay, no more energy for you. And then all of a sudden we got less energy, not more energy as we move through 2025. What I think this means, right, this combination of things is A, we're probably going to go soft on Canada from a tariff perspective. And B, it probably means that we're going to see more public and private investment into things like nuclear energy, which I know you mentioned, kind of this silver bullet that is in sort of a political quagmire. It's got some bad press for good reason a while ago, but maybe some new education is necessary around that. So this idea, right, is that we're going to have to be spending, we're going to have to be trading, we're going to have to be investing. Yesterday's news on paper throws a shock into the system. And yesterday's news, of course, is that China announces that their basically answer to ChatGPT is almost as good as ours, but they did it without all the chips that we restricted their access to, and they're doing it with a fraction of the energy requirement. And now everybody's saying, well, oh, geez, do we actually need all this investment in infrastructure? The two things I'd say on that are, A, this is China we're talking about, so you have no idea if what they're saying is true. You need this stuff to be independently verified. That's very important to point out. And B, there was always an economic incentive, even before China showed up with this large language model yesterday, to bring down the costs and increase the energy efficiency of large language models and of artificial intelligence in general. So I think the story still stands at a very high level. We're going to need to invest a lot more in infrastructure in this country. And in fact, infrastructure as an investment idea has been gaining a lot of traction in recent years because of exactly this.
I was thinking about the DeepSeek freak out last night. Thinking about it last night, what happened yesterday, one of the things that occurred to me is that there's not a finish line as it pertains to technology and innovation. It's not as if China has beat us to the finish line and the race is over, and now we don't need chips and now we don't need energy.
Yep.
So I thought that just in terms of understanding that that there may be some shape shifting in terms of where these things manifest, but certainly we will still need more energy. Certainly we will still need more chips. And to your point, it is, I love the way you said that. It is China that we're talking about. So there's a healthy degree of skepticism.
Yes.
Well, Jack, thank you again so much for your time. I have thoroughly enjoyed our conversation. I would sum it up with a word picture. When my boys, who are now 31 and 29, when they were younger, they had a plastic per se square that had these kind of holes, a pattern of holes, and then you had these plastic gears that kind of went down into each hole, and the gears were flat on the piece of plastic, and they all kind of the teeth interlocked kind of thing. And if I'm painting the picture correctly, you'll understand that when you turned one gear on the board, every other gear moved. And so when we talk about interest rates, when we talk about AI and DeepSeek, when we talk about employment or unemployment and GDP and shelter and all of these different things, you turn one of those wheels a little bit and every other gear on that board changes. And it's just truly fascinating to see how these things all relate to each other, kind of the cause and effect aspect of this world that we live in. So again, Brittany, thank you so much for running the show and keeping Jack on track. And Jack, thank you so much, and best wishes to you and the team at JP Morgan, and our friend Christopher Scales, who's not with us today, but we certainly appreciate you very much. And to each of our clients and friends who have joined us on this call, we thank you. We hope that you found it to be insightful, informative, and helpful. If you have any questions about any of these topics, please feel free to reach out to our team here at Covenant Wealth Strategies, whether it's high-level questions or how they specifically apply to your circumstance. We're all about that, and we love what we do, and we love helping you with how it applies to your situation. So with that, we'll bid you all adieu. Thank you again all very much.
Thank you.